Hey, good morning and welcome to the ParkBridge Wealth Management Spring Webinar Series. This program is entitled Hot Topics in New York Tax Audits and Enforcement. As always, my name is Jonathan Shenkman, and I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients, and this is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcast. Today, we're privileged to hear from Timothy Noonan from Hodgson Russ, based in Buffalo in New York City. By way of background, Tim is a partner and tax residency practice leader at his firm, where he focuses his practice in the state and local tax area. His work primarily involves New York State and New York City tax litigation and controversy. Over the past 20 plus years, he has handled more than 2,000 personal income tax, sales tax, corporate tax, and other New York tax audits. Tim also has handled over 100 cases in New York's Division of Tax Appeals. Tim has handled some of the most high-profile residency cases in New York over the past decade, including a 2014 win in the Guyed case, one of the first New York residency cases to ever reach New York's highest court. He's often quoted by the media's outlet, including the Wall Street Journal, New York Times, and Forbes, on residency and other tax issues. As the Noonan and Noonan Notes, a monthly column in Tax Notes, state, Tim is a nationally recognized author and speaker on state tax issues. Today, Tim's going to be speaking on hot topics in New York tax audits and enforcement. And with that introduction, I'll now turn the program over to Tim.
All right, thanks, Jonathan. Hey, everybody. Good morning. Nice to be here again. It's a annual event, speaking with Jonathan. So I very much appreciate the invite to this group. And I mean, this topic is in one sense somewhat of a niche topic, like New York taxes. Like, what does that have to do with me or my high net worth clients? But in particularly around the state of New York, this has been a big issue. Because New York's audit and enforcement efforts have for years been focused, well, sort of on everybody, but in every company. New York is very aggressive, but in particular in the high net worth space, in people moving from New York to Florida, people who work in Connecticut or live in Connecticut but work in New York. In other words, a real focus on auditing individuals for their own personal taxes. And that ends up obviously being a significant issue for high net worth individuals, their advisors, because issues are popping up all the time. So it is a big topic in this space. So just want to spend some time, this morning giving you a sense of what's going on. What are the hot topics in New York? What are some of the big cases and issues, to give you a sense of things that you and your clients should be looking out for. So with that intro, we just got some really interesting data from the tax department. We did a freedom of information law request, as sometimes we do, just to sort of, I mean, the government's great. They have to give you information if you ask for it. So we asked for information about, like, hey, what's going on, like, from an audit perspective? How many audits are you doing? How many dollars are you collecting? We like to have a sense of that for a couple of reasons, both so we can properly advise our clients and, as my business is, handling and defending a lot of these cases, it's interesting to see what's going on. And we had a sense that things were changing a bit, not so much in the flow of work that I was seeing, but just in the number of auditors in particular that were out there. And if you look at the data here on this first set of slides, you see a drop in auditors who do sort of the regular auditing, for the tax department, dropping, from 360 or so in 2000 down to under 250 in 2024. We certainly knew that was going on. That was in part actually due to the Internal Revenue Service. Remember, a number of years ago, President Biden allocated, I don't know, $87 billion or something to like beef up the IRS, and they did. And they hired a lot of people. Funny story, or maybe not so funny, like that's changed, right? So lots of those tax department, New York Tax Department auditors that got hired away to work for the IRS lost their jobs in the past 6 months or so. A lot of them are coming back, but you see a drop in auditors, and you see a sort of a drop in audits in the next slide. We track there both like residency audits. Again, we'll talk about that in a minute. That's probably the biggest topic in the high net worth space in terms of how to deal with state residency in New York. And so we see with the drop of auditors, we see a drop in audits. Not really surprising. I mean, the sort of sheer number of drop in audits actually was surprising to us to see that. That could be a blip. But we do have a couple of years that they did less than 1,000 residency audits, which is again a bit surprising. There was a big blip. You see that in 2022. I don't know what they were doing there. That just in regular audits, they went way up, but that seems to be trending, obviously trending way down again. So good news potentially that sort of audit enforcement appears to have gone down. The next set, although, is interesting because and again, the data here might be a year lag. Like if an audit is opened in 2022, it probably doesn't get closed until 2023, et cetera. So on one side, we see number of audits closed with no changes. That's no change is very good news in my world. That's a win. So no changes are great. And the flow of those seem to sort of go with the audits, though. The percentages maybe seem to be the same. But then on the next side, you have the total number of audits where they didn't agree. And there's still, that doesn't really flow as much with the trend of cases. There still is a similar amount of disagreed cases, even when you have, 10,000 audits versus 2 or 3,000 audits, which is kind of interesting. So they're still sort of fighting maybe the same amount of cases at the appeals level. They're just opening more cases, and maybe that just means they're kind of inefficient. They're opening lots of cases where they're just saying, "Oh, I guess." Well, or maybe they're getting better, because that could mean there's agreed cases here where they assess a tax and it gets paid. That would be on neither chart here, right? This is just the difference between total victories for taxpayers and in cases that end up disagreed. But so you see that. And then just dollar wise, this sort of tracks with the number of audits. This is like the amount of dollars they collect. But I mean, this is big business in New York State. They collected or at least they assessed over $1 billion in disagreed cases, for instance, in 2023. Obviously, it's a big number. They collected 500 million in 2023. So again, this is, for New York State, it has been a big business. It does sort of makes me question what's going on back there in the first slide, where the number of auditors are dropping, the number of audits are dropping. I don't think that's by design. I don't think they want that. But they lose, it's the government, so they lose people. It's sort of hard to quickly fill people. They can't just say, oh, we're going to pay people a lot more to get them in, like a private business would be when they have like a war for talent. Can't really do that at the state. It's a little more, lockstep, and it takes a lot of time and energy and legislation or whatever to change compensation. There's union issues, so they just move a lot slower. So I don't necessarily think that the enforcement is going to continue to drop as it is. If it does, I'll be talking about something different next year. I'm just kidding. But it is an interesting trend that I would say in 26 years of doing this, I sort of haven't seen that. But again, I think it's the loss of audit staff that they're shoring up now. That could be a direct cause of that. Okay, so let's get into a few substantive topics today. So residency audits, like I said, this is a big topic in New York State, kind of for an obvious reason. The highest New York State personal income tax rate is now 10.9%. If you are fortunate enough to live in New York City, add another 3.8% on top of that, like 14 or so percent in state and city or state and local personal income tax there. That's the highest in the country. when you think about the combined rate. And since 2018, as I'm sure many of you know, essentially you're not able to deduct your state and local taxes, the so-called famous SALT deduction. That went away or was capped at $10,000 a year in 2018. So that made the sort of sting of 14% state tax rate. That's before you pay $1 in federal taxes, right? Or I should say that's after you pay many dollars in federal taxes. You still have to pay up to 14% New York taxes. That's heavy duty. And when you can't deduct that, that's even worse. So that means people think, I think I want to get the heck out of here, right? 5 years ago, COVID hit. Jonathan still did a webinar. I remember it very well in early May 2020. But not like I was some genius, but I predicted at that time, hey, I think a lot of people are going to move from New York. Sure enough, they did. Tons and tons and thousands and tens of thousands of people left. And many of them became my clients because they needed help leaving, and now they're all getting audited. So, but residency becomes such a big thing because the tax rate's so high. So people are trying to avoid that totally legally by moving or by spending less time in New York. And New York doesn't really like that. So they're looking at those folks. Incidentally, just a side note on the SALT deduction, that's sort of in the news all the time now, right? Will the feds change that? Will they get rid of the cap and start to allow taxpayers in high tax states like New York and California to start to begin to be able to deduct their state taxes again? I mean, the short answer is, I mean, I don't know. I probably know as much as you and Google knows or AI, but I don't think it's going to happen. Like in terms of probably what will happen is they'll raise the cap from $10,000 to $20,000, which if you're a New York taxpayer, you're paying $20,000 in tax like by January 14th or something, right? So they'll raise the cap a little bit, or maybe they'll raise it even higher, but they'll limit it to taxpayers making under $400,000 or something like that. So I think that the cap itself that impacts all of our clients is for all intents and purposes likely to stay. It's really just too expensive at this point for the feds to turn that off. There is, of course, as many of you know, sort of a fail-safe to that. There's many states, pretty much all states. New York has a PTET, a pass-through entity tax, that's designed to soften the pain or really get around the pain of the SALT cap. So those are still alive and kicking and great to avoid the pain of the SALT cap, but those are out there. But in any case, the SALT cap, high taxes, bad weather, whatever. People are moving. People move. People are moving. It's an issue. I note here that 300 auditors. Actually, I should revise that slide because now it's 240, at least based on the FOIL data we just got a couple of weeks ago. So auditors are dropping. So what does that mean, like in terms of an audit? It's a big question I get all the time. Like, people call me, hey, I want to move to Florida. Am I going to get audited? And the sort of math isn't really all that complicated, right? The more you make, the more likely it is they're going to audit you. They're not, they're business people, so to speak. They're not going to chase after taxpayers who make $100,000 a year because the most amount of tax they could get on an audit like that is like $5,000. They're just not going to do it. They're going to chase after the bigger dollars. So the higher your income is, the more likely you're going to get audited. These days, I think if your income is under $1 million, you're probably not going to get audited. Not talking wealth or anything. I'm talking annual income under $1 million. I just don't see them chasing after those audits anymore. We've seen it. They don't have the staff to do so. They're focusing on the larger dollars. Maybe that's even growing now with more people moving, right? And less people to audit. Could that be 3 million, 4 or 5 million? Maybe. I still see audits in that realm for sure. But I think, whereas I probably would have said pre-COVID, over $1 million or so, your likelihood of audit on sort of one of these residency cases where someone's moving from one state to another is pretty high, maybe close to 100%. I can't say that anymore. If your income is over $10 million, I think it's probably still very close to 100% that there's going to be an audit. Again, they still do a lot of these audits, but again, have more data and more intel on that maybe in a year as we see if they've shored up their audit group, because I mean, they can't audit everybody. And there's only so many, so much time in the day. So I think the audit likelihood could go down. Maybe that means people start to be more aggressive. Like if you're going to get audited and someone calls me and says, oh, here are my facts. Here's what I want to do. And I say, you're going to lose. Then if we know we're going to get audited, maybe we don't do it. But if someone's like, well, there's a 30% chance I'm going to get audited, what the heck? Maybe I'll give it a shot. And that's key, right? Because in these cases, again, when we're thinking about, you have a client who's thinking about making a move, the burden of proof issue here is so large. There's no close calls. You have to prove by clear and convincing evidence that you've changed, in this case, if you're changing residency, that you've changed your residency from New York to the new state, to Florida. There's two tests in New York. One is the test everyone knows about. Oh, I'm going to meet my days. I'm going to spend more than 6 months out of New York. That's fine. There is one rule that says you can't spend more than 6 months in New York, or 183 days. If you do that, game over, you lose. But even if you're under 183 days, you can still be taxed as a New York resident if the tax department determines that your domicile or your primary home hasn't changed, that it's still in New York. That ends up being a balancing test between your ties in New York or your ties in Florida. And that's where I say a close call, we're going to lose that case because they're going to say it's not clear and convincing. Clear and convincing is, a lot heavier weighted towards Florida and away from New York. And oftentimes your time patterns are the biggest or the best piece of evidence there. And if you spend about the same amount of time in New York and Florida, they're going to say that's a close call, and that's going to favor the government. The wider that gap in days gets, the better the case is going to be. So as we're advising people on these moves like this, we are focused a lot on time patterns and how much time people are spending in different places. With that, of course, becomes the question of, well, how do we prove it? How do we prove our days? And, maybe 20 years ago when I was doing these things, I don't think we had webinars 20 years ago, but it was a little tougher, right? You'd easy pass, credit card records, people using cash a lot. We had to prove in these cases, the burden of proof's on us. We have to prove where we were every day of the year. And that actually was tough. It was tough years ago. Now we got cell phones. We're all carrying around these cell phones. They're pinging towers here and there. And most of the carriers will give us that data. It's a lot easier to see where people are. There's apps people have on their phones now. Most of my clients coming to me are aware of them. They're using apps to track themselves. So that's become a little bit easier. But proving where you are in these cases is again a very big deal. So that's what we got on the audit side. And last thing I'll say is these cases aren't all or nothing. They're not binary. It's not win or lose. Oftentimes, when you have these residency cases that are kind of facts and circumstances, settlement is definitely an option, and they will settle cases. Speaking of cases, the other big update really since COVID has been this whole convenience rule thing. What's the convenience rule? Well, the convenience rule is basically New York's telecommuting rule. If I'm not a resident of New York, but I'm working in New York and I'm getting salary, wages, bonuses, compensation like that, I have to pay tax to New York based on the amount of days I work in New York. Pretty easy math. How many days did I work in New York? Okay, I worked, 60% of my days. I got to pay tax on 60% of my compensation. Again, if I'm not a resident. If I'm a resident, I pay tax on everything. That's easy. Well, New York has a rule and has had a rule for decades. If you're telecommuting from home to your New York office, and you're doing so for your convenience, New York's rule is that's a New York day for purposes of doing that math. You got to treat that as a New York day. That's called the convenience rule. And convenience historically has been really defined very broadly. The only thing that wasn't a convenience day in the tax department's mind was if your employer told you to go work, at our client site in Connecticut or go work in New Jersey. If you're just working from home, the New York's rule was that's going to be a New York day, even if you're working from home in New Jersey or Connecticut or Florida or wherever. Well, and that was the rule for decades. And there's been cases here and there on it, but it sort of quieted down until something called COVID, when everyone started working at home again. In New York, doubled down on this telecommuting rule and said, basically, we don't care that You worked from home for most of 2020 and 2021. Heck, we don't even care that your office was closed and you had nowhere to go. We're still going to apply our convenience rule. Well, that's under attack now, or the taxpayers are fighting that. We have a number of cases still kicking around on this issue. There's a case coming out probably in a couple weeks. A professor, Ed Zielinski, who had a case with New York 20 years ago where he fought the convenience rule and loss, has revived his claim now post-COVID, arguing, in essence, he's arguing a number of things, but I think the one issue that I think we're all watching super closely, because it matters for a lot of 2020 and 2021 cases, is whether or not this telecommuting rule can apply even if the employer's office was closed, which again, for many employees, they didn't have anywhere to work in 2020 and 2021. So the idea that those days worked at home could be convenience days is kind of silly. So we're expecting a ruling from New York's Tax Appeals Tribunal in a couple of weeks on that. And when it comes out, I'm sure it'll be all over the news. It'll be sort of the biggest case involving sort of COVID tax enforcement in New York that's really come out. So that'll be interesting to see. Couple other things. Corporate tax reform, which, you might say, well, we're really here to talk about individuals and high net worth tax planning and things like that. What would I care about corporate tax reform? Well, one of the things that comes up a lot is pass-through taxation. Individual taxpayers who are shareholders of S corporations, compute their tax based on the corporate rules. So corporate rules do become relevant for lots of individuals. And just interestingly, the state changed a lot of its corporate tax rules back in 2015, made a lot of changes in the way corporations were taxed, pretty much designed in part to bring in more revenue from out-of-state businesses and out-of-state companies. But it then took the tax department 9 years to issue tax regulations, which were extremely substantive, like thousands and thousands of pages of substantive rules enforcing the statutes that came on the books in 2015. And for some of these, obviously, taxpayers didn't like the results of the regulations, so they've started to challenge them. In one case, just a couple cases that came out in the past couple months, Paychex sued New York, arguing that in a special apportionment rule that was put in place in the regulations was both inconsistent with the statute and it shouldn't be applied, retroactively back to 2015 anyway, which is what the tax department tried to do with all of its regulations that it passed or issued in December of 2023. In another case, one part of the regulations took sort of a swipe at the nexus provisions in Public Law 86-272, which essentially protects out-of-state businesses from income taxes if they have no physical presence in New York outside of sales activities. In any case, taxpayers in both these cases challenged both the viability of the substance of these rules, but also the idea that what the heck, you can't go back 10 years on these rules. And, we're one for one. Like in one case, the taxpayer lost, the court said, no, it's fine. They can enforce these rules retroactively. In another case, the 86-272 case just came out like a week ago. The court said, nah, 9 years is ridiculous. You can apply it prospectively, New York, if you want to do that, but you can't apply it retroactively. And, that's a bit of, sometimes courts and judges come out differently. It could be something in the facts. In the Paychex case, there was more of a history of back and forth with the taxpayer and the government about the change. It was kind of like, hey, you guys knew this was coming kind of thing. So that could be a difference in these retroactive cases. But certainly that's something that's out there as well. Okay, so New York City taxes. So New York City has its own sort of separate tax enforcement regime. And this regime actually relates to New York City's tax called the unincorporated business tax, which again is a tax on businesses per se, but it's on flow-through businesses, partnerships, LLCs, sole proprietorships. And New York City has been very aggressive enforcing this 4% tax against providers, really provide a lot of providers of services in New York City. Your accounting firm, your law firm, your wealth management firm, your hedge fund, your private equity management company, like these businesses doing business in New York City, their owners have to pay taxes, right? Based on the personal income taxes, that 14% potential tax I mentioned. But the entity also has a 4% tax just on the entity's business income. And New York City has been extremely aggressive in going after taxpayers on particularly in the financial services area. Again, the hedge funds, hedge fund management companies, private equity firms, firms that have built homes for themselves in New York City. And the city is like, thank you for doing that. Now we're going to audit you, right? So lots of enforcement. This is another reason we saw lots of hedge funds and such move to Florida in and around COVID to avoid situations like this, where in addition to the owners having to pay a 14% tax, there's a 4% entity tax on top of that. But again, the city is focusing on a couple of different areas. One of the big areas is apportionment. So, if you're a business in New York City, you have to pay this 4% tax. But if you're a service provider, you might not have to pay it on 100%. The allocation or the apportionment rule is based on where you're performing your services. So the percentage of services you are performing in New York City will dictate how much tax you have to pay. So if you're only performing half of your services in New York City, then you're only paying half the tax that you would pay if you were performing all your services in New York City. Well, again, COVID made an issue of that because people were like, well, wait a minute. All of our people in 2020 and 2021, they sort of went home and they worked from home for a year or so. And many of those folks didn't have homes in New York City. Well, there's no convenience rule, right? There's no telecommuting rule that I talked about a couple of minutes ago for this UBT tax. It's really where people were doing the work. So if you were not doing the work in New York City, you could lever down your apportionment percentage. So that's been something that a lot of taxpayers did to lower their New York City taxes. Now the city is auditing lots of those cases. And interestingly, they're not saying that taxpayers can't do that. They're allowing taxpayers to lever down their apportionment if indeed services were provided outside New York City. But you got to prove the services were provided outside New York City. It becomes an issue of proof, similar to kind of like the day count thing I was mentioning in residency cases, but it's a similar idea. If you have a bunch of service providers, you're providing, investment management services, and you have portfolio managers and folks working from different places, you got to figure out where they were. Where were they working? They're working from home outside the city. That's great. We can treat that as non-New York City services, but we got to be able to prove it. So, but again, the city isn't saying, I had one case where the city said, the auditor said, well, 2020 was a weird year, so we're going to use 2019, and we're not going to allow them to sort of get the benefit of all the work from home and whatnot in 2020. And they issued a tax bill to my client based on that, but we took it to the appeals level, and the appeals people were like, no, it's not the rule. You can definitely look to where people were, but prove it. So we had to still prove it. But the concept that, somehow the normal rules wouldn't apply to 2020 or 2021 has been ditched. So I wouldn't worry about that. The last thing I'll say, and it's an issue somewhat in New York State too, but in New York City especially, man, these audits are taking forever. The city, like the state, has lost a lot of audit staff. So the cases are really old. They're big cases. There's lots of issues. There's not enough auditors to do them. Cases are going on and on. And the other thing that's happening is at both the state and city level, there's like a tax court system. So if you don't like the result you get in your audit, you can appeal it. There's administrative law judges who hear cases. There's sort of like an appellate review body that looks at those cases, all within sort of the tax department structure. Again, it's basically like New York State or New York City's version of tax court. So they have these tax courts, but they're kind of dysfunctional. The city tax court is especially dysfunctional. Right now, there's no judges. Like all the judges are gone. So we have cases sitting there, and it's like there's nothing to do. We're all sitting waiting for a judge to even sort of get hired. There's just no judges. So that's kind of a problem. I actually just wrote a piece about that in Tax Notes in my monthly column, just about kind of that dysfunction and how there's no judges. So that's a problem. If you don't have a judge to adjudicate your matter, it's kind of tough to get a good result. So that's been a problem too in the tax enforcement realm in New York City. Okay, so got through the topic. All my contact information is there. If you guys have questions, feel free anytime to call me, shoot me an email. Happy to take questions about this or any other New York tax or other state tax matters. And That's all I got, Jonathan. Over back to you.
Great. Thank you so much, Tim. If anyone has any specific questions, new business opportunities, or any other issues I'd like to discuss, please feel free to reach out directly to Tim or myself where appropriate. And I'll also be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we could all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Three more quick items before I let you go. First, my next webinar is Tuesday, May 20th at 8:30 a.m. featuring John Kiley of McDermott, Will, and Emery based in New York City, who's going to be speaking on the topic of the IRS issues final regulations on gifts and bequests from covered expatriates. And I'll be sure to send out an invitation to this program in the coming days. In the meantime, I'd love to continue to grow this webinar community. So if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line. I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on X and Instagram at Jonathan on Money. And by connecting with me on LinkedIn, you could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.